Dear friends and investors, welcome to our monthly video on markets and investing. We're almost coming towards the end of the year, and what an eventful year it has been, like it usually is. There is always something to talk about. But this month, we will take a recap of the Q2 earnings season, which has almost come to an end. We will decipher the trends, what it means, and what the future holds for us over the next 2 quarters as we finish the financial year FY25. So first, coming to Q2 earnings. As we mentioned to you last month, where we were still the Q2 earnings season was going on, that the earnings season was very tepid. And that's been the case at the end of the earnings season as well. If you look at the top 500 companies, virtually 497 companies have declared their results, and the numbers don't look very pretty. The top line growth was almost 7%, but bottom line growth was very flattish at 2%. And it was the same case with a very narrow Nifty as well. Nifty top line growth was 4% and bottom line growth was 3%. And this time, for a change, if you do between financials and non-financials, it was really financials which kind of stood out when we look at the aggregate picture. Financials delivered a 13% growth in net interest income and a 17% bottom line growth, and that stacks up reasonably well when you look at an overall picture which was quite flattish. Now, why did this happen? Obviously, we did mention that there were several reasons. A, we had the monsoon season, which is usually very lean. We had an election season, which means that government spending was running way below the targeted levels. And we also had a little bit of an impact on margins of manufacturing and non-financial companies, which compressed by roughly around 200 basis points. And that's why we had a very flattish quarter, so to speak. So practically speaking, between Q1 and Q2, that is the first half of this financial year, the earnings growth has not been that great. Having said that, the aggregate picture may be very flat, but there were winners and laggards. If we look at the top 6 sectors which delivered phenomenal earnings growth, then the pecking order would read something like this. The new age and e-commerce companies had a phenomenal earnings growth of 298% in Q2 over last year. Obviously, we had a benefit of a very poor base last year. As you know, many of the new age companies were losing money, and many of them have turned profitable. And therefore, you see a significant swing in the earnings numbers. And that's also reflected, as you all know, from stock prices. So whether it is Zomato, whether it is PB Fintech, and several other new age companies which have shown very strong performance on the bourses as well. Second in the pecking order, after the new age and e-commerce companies, which obviously had a phenomenal quarter, was consumer durables. And particularly within consumer durables, 2 subsectors did phenomenally well. One is EMS companies, which is the electronic manufacturing services. All those businesses that basically assemble mobile phones or are involved in manufacturing parts that go into washing machines, televisions, refrigerators, air conditioners. And typically EMS had a very, very strong year in the second quarter. And along with that was also the AC manufacturers, because we had a very hot season and AC sales had a scorching sales. Third was exchanges. As you know, not too many of them are listed, but having said that, both MCX and BSE, and especially the capital market companies, did phenomenally well, obviously given the kind of volumes and the buoyancy that we've seen in the capital markets. Metals and mining, healthcare, followed by banks. So this was the pecking order for the top 6 sectors which drove earnings growth. Now obviously, despite new age, consumer durables, exchange, metals, healthcare doing phenomenally well, it does not reflect in the aggregate numbers because the share or the weight of these sectors in the index is very, very low, and therefore we had a very flattish growth at an aggregate level, but these sectors really stood out. Which were the laggards? Cement at minus 59%, energy, which was largely the oil and marketing companies, minus 46%, plastics 24% negative, building materials 24% negative, textiles 19% negative, and agrochemicals 6% negative. So these were the sectoral laggards and leaders. And finally, if we look at which sectors had earnings upgrades, which means that after the Q2, where was the full year numbers upgraded? Those came from consumer durables, metals, cap goods, logistics, and infrastructure. And where were there significant earnings downgrades? Textiles, cement, chemicals, building materials, and new age companies, but that was largely because of one stock, which was Paytm. However, even Paytm is on a significant profitability improvement going forward as well. So therefore, as you can see, while the aggregate earnings were very flattish, we've had significant winners. And many of you would have known that luckily for us, our portfolios are very well positioned and have a significant exposure to sectors which actually grew and where there were significant upgrades. As you all know, friends, that we have been consistently maintaining that this cycle post-COVID is very different from the cycle pre-COVID. And largely the growth has been driven by domestic manufacturing sectors and sectors which are considered to be more cyclical or where there has been a significant stress on Make in India. And therefore, we believe that this trend is a secular trend and is likely to continue, albeit we did see that in the first half, there was a slowdown in many of these cyclical or infrastructure or cap goods sectors, largely, as I mentioned earlier, driven by lower government spending because of elections. And therefore, if we look at the trend in Capex, what we have shown is that this is not something which is new. Even last time, when the elections were in 2019, you will see that Capex was down by almost 30%. And then, as we exited the election season, we saw that Capex picked up. And we are starting to see a very similar trend this time as well. Not only this time did we have the general elections, but we also had a couple of state elections, which further delayed the government giving out orders for infrastructure across several sectors. And if you remember, last month we mentioned that the April to August Capex was running at 35% below the budgeted levels. However, in September, we've seen a significant pickup, And we believe that in the second half of the year, you should see a significant acceleration in Capex. Also, it is important at this stage to mention that a very important event, which was the state elections, has turned out to be quite positive for the BJP. The BJP won two very significant states, Haryana and Maharashtra. And that has given a big shot in the arm for the government. There seems to be a spring in their step, and the confidence of the ruling party is clearly seen and has come back. And that gives us a significant confidence that the vision of the Prime Minister that we will double down on Make in India, on infrastructure development, on Capex will re-accelerate as we get into the second half of the year. The other good news is that we do not have any significant state elections for the next 1 year. Probably Delhi will go for elections in February 25, and then the next major election in Bihar is only in November 2025, which means that the government has clear 12 months to focus on the economy, and there should be no disruptions in the momentum of Capex spending in the country. Also, if we really look at the trends globally, right? If you see, there was oft a concern that private Capex has not picked up in India. However, if you look at the data, we are beginning to see that the private Capex of the listed universe is improving. And as you can see in the chart, it looks very similar to the period from 2001 to 2005, 6 and 7, when you saw a significant increase in private Capex. It was from 2012 up until 2021 that private Capex was almost stagnant. And now, as you see the data in the chart again, it is very clear that from 2022, we have seen not only government Capex going up, but even the private sector has started to contribute towards increasing Capex. And that bodes extremely well for many of these sectors. If you look at the trend, right, China went through a similar trend. If you see, Chinese Capex in 2002 was $1 trillion US dollars. And then consistently for the next several years, we've seen a significant pickup in Capex in China. India is exactly where China was in 2002. We are almost nearing $1 trillion in Capex, and we believe that over the next several years, we should see this trend accelerate in India. And therefore, this is important. This perspective is very important because our positioning in the portfolios is exactly aligned to our broad thought process that this is the decade where we need to double down on spending on infrastructure. We will benefit from the China Plus One strategy. We do believe that as the new Trump administration takes office in early part of next year, we will see a significant re-acceleration in the China Plus One opportunity across sectors that we are seeing. So friends, despite the tepid first half and despite the broad corrections that we have seen in the market in the last few months, our portfolios have held up very, very well, and we have stayed steadfast with our conviction in our portfolio positioning, which is focused towards companies that are growing much faster than the average. And as you all know, that we have made significant investments in new age companies which are taking away market share from traditional consumer businesses. We have focused on premium consumption, which we believe is a long-term structural trend. We have focused on Capex and the investment and manufacturing theme, which again, despite a cyclical slowdown, is likely to re-accelerate as we move into the future. And we also have a significant exposure to specialized technology and healthcare companies, which continue to do far better than what the average sector is delivering. So we remain fairly confident and watchful and look forward to a much better second half of the year. With this, I sign off and I will meet you on the other side of the new year early in 2025.